Here's a brutal truth you won't like. Your biggest losses aren't red trades. They're the green trades you murdered too soon. Selling too early is the tax amateurs pay to fear, while professionals refuse to pay it. Jesse Livermore learned this the hard way in 1906 when he clipped a quick $10,000 profit on Union Pacific and breathed the sweet relief of certainty. Days later, that same stock sprinted without him, offering another $50,000 he'd trained himself not to take. That single premature sale didn't just cost him $50,000. It cost him the equivalent of $3 million in today's purchasing power. But here's what's worse. This wasn't just about missing money. It was about missing the fundamental mindset shift that irrevocably separates amateurs from professionals. The amateur trader operates from constant anxiety and desperate need for quick relief. They see a modest 20% gain, and an internal alarm blares, driven by primal fear that the market will snatch away their hard-won profit. Lock-in profits, they frantically tell themselves. Don't be greedy, but this isn't prudence. It's poverty with better manners. This immediate gratification, this impulse to sell at the first sign of green, isn't making them rich. It's actively conditioning their brain to think small, to accept mediocrity. At precisely the moment the market extends an invitation to think big, the professional trader approaches markets with entirely different psychology. They think in strategic campaigns, not fleeting skirmishes. They understand that premature selling isn't just leaving money on the table. It's training your subconscious to fear success instead of embracing it. Consider the stark mathematical reality that destroys amateur accounts. If your strategy consistently leads you to secure modest 6% gains while missing the truly significant 54% trend-following moves, you're caught in an impossible trap. To make up for one missed 54% move, you need 9 separate, perfectly profitable 6% trades. 9 consecutive winners with 0 losses. And we both know that's an unsustainable fantasy. This calculation assumes no slippage, no fees, and impossibly, no losses ever. Real life adds friction everywhere. The amateur celebrates small wins, while the professional captures life-changing moves. The chasm between these approaches isn't bridged by luck, capital, or intelligence. The fundamental difference lies in identity and meticulously honed methodology. Picture this common scene that plays out thousands of times daily. You buy a breakout at $50 after clean consolidation and strong close. By Wednesday, it tags $55. Your chest tightens. You imagine the pullback that erases your paper gains. You hit sell, feeling smart and responsible. A week later, it's printing $72 on surging volume while you refresh your account balance. Proud of crumbs. That safe exit cost you $17 per share and, worse, it trained your brain to choose relief over return. Each early sale wires this destructive habit deeper. This is precisely how portfolios plateau and dreams die. You didn't just miss profits. You reinforced the neural pathway that keeps you poor. Professionals anchor exits to structure, not emotions. They keep stops beneath pivotal points, not beneath anxiety. They define risk in advance with position size, typically risking 1 to 2% per trade. They don't watch every tick. They watch character. Is the stock obeying its trend? Are pullbacks shallow and bought? Does volume confirm strength and punish weakness? If yes, they hold. If structure breaks on heavy volume, they exit without debate. Simple protocol beats heroic improvisation every time. Livermore, after countless battles and hard-won insights, eventually distilled his experience into 3 hidden rules that offer complete cure for early selling affliction. First rule: never take the first sale. That initial, impulsive urge to exit a profitable position is almost invariably wrong, driven by your fear clock ringing, not the price clock speaking. This first impulse, whether whisper of relief or scream of panic, is precisely what you must override. Second rule: pyramiding only works at confirmation points. You add to strength, never hope. Add only when the market pays you to add higher highs, higher lows, rising volume, tight pullbacks that resolve upward. Most traders do this backwards. Averaging down on losers while taking profits too quickly on winners. Third rule. Waiting is a position. Doing nothing protects capital and preserves clarity. The market pays for patience and fines for fidgeting. True wealth compounds not through frantic activity, but through strategic patience that allows trends to mature fully. Here's a paradox that will keep you honest. Doing nothing is sometimes the highest return trade available. Waiting protects you from random noise and from yourself. When you're flat, your only risk is missing opportunities. When you're wrong and still holding, risks multiply exponentially. Professionals accept missing moves. They refuse to accept losing discipline. Flat is a position, cash is inventory, and patience is edge. Studies reveal that 80% of trading profits come from just 20% of trades. Those monster moves that make careers only reveal themselves over time. They look exactly like every other trade when they start. The only way to capture them is systematic protocol that keeps you in winning positions until evidence changes. You'll learn a mechanical framework that removes emotion from exits, uses pivotal points to guide decisions, and transforms your relationship with unrealized profits. This systematic approach channels emotions through profitable behavior patterns. If you've ever watched a winner run without you, if you've ever sold too early only to watch your former position double, this protocol ensures it never happens again. The amateur sells when they feel good. The professional sells when evidence changes. That distinction determines whether you join the 90% who lose or the 10% who consistently extract wealth from market inefficiencies. Your brain operates two completely different timing mechanisms simultaneously, and they wage relentless war for control of every trading decision you make. The fear clock screams with primitive urgency the instant you glimpse green numbers, demanding immediate action to secure whatever profit exists before it vanishes. This ancient survival mechanism evolved over millions of years, hardwired for environments where hesitation meant death and quick rewards meant another day alive. It's purely emotional, designed for a world where delayed gratification could literally kill you. The price clock whispers with quiet logic and infinite patience, understanding that modern markets reward those who wait for objective confirmation. This rational system thinks in weeks and months, not heartbeats, recognizing that delayed gratification creates fortunes, while immediate gratification creates poverty. Amateurs obey the fear clock religiously, mistaking its urgent demands for prudent risk management. Professionals have trained themselves through disciplined repetition to silence the fear clock's screaming and listen exclusively to the price clock's measured wisdom. Here's the exact scenario that destroys millions of retail accounts systematically and robs traders of life-changing wealth. You identify a clean breakout setup after proper research and buy shares at $50 following solid consolidation and volume confirmation. The position immediately moves favorably, reaching $55 within days. Your fear clock explodes into frantic action, pounding relentlessly inside your chest. Take the $5 per share. Lock in the profit. What if it reverses overnight? What if news breaks against you? What if this is the exact top? The anxiety becomes unbearable as images of loss flood your mind. You capitulate to the primal fear and hit sell, feeling immediate relief wash over your nervous system like a drug. 1 week later, you watch in horror as your former position prints $72 on expanding volume with perfect trend continuation. Your safe $5 gain actually cost you $17 per share in pure missed opportunity. But the deeper damage runs far beyond simple mathematics. You've just powerfully reinforced the exact neural pathway that prioritizes fear over profit maximization, making this same wealth-destroying mistake increasingly likely in all future trades. This isn't merely about one poor decision or temporary missed profits. Neuroscience reveals that every time you sell prematurely, you're literally rewiring your brain to choose comfort over wealth through powerful biochemical processes. Our brains form stronger neural connections around emotionally charged decisions, and the relief you felt from locking in that modest gain creates an intense positive association with early exits. Your subconscious mind learns that selling equals safety while holding equals danger, and this conditioning becomes progressively stronger with each repetition until premature selling becomes your automatic default response to any profitable position. You've systematically trained yourself to remain poor through what feels like responsible risk management, but is actually fear masquerading as wisdom. Jesse Livermore understood this psychological trap better than any speculator in history, because he experienced its devastating effects repeatedly before mastering it completely. He called the stock tape the greatest teacher, because it revealed objective mathematical truth that existed entirely beyond emotional noise and human bias. During his legendary 1907 campaign, when Steel Common began its historic decline from 95 to 85, amateur short sellers immediately covered their positions, satisfied with quick 10-point profits and terrified of potential reversals. They obeyed their fear clocks, grabbed modest gains, and missed the move of a lifetime. But Livermore read the tape with entirely different eyes, trained through years of painful losses to see beyond surface emotions. He noticed volume was actually increasing on each decline, indicating serious institutional distribution rather than temporary profit-taking. More critically, buying wasn't appearing at obvious support levels where value investors should have stepped in aggressively. The character of each downward move showed underlying strength in the selling pressure, not exhaustion that would lead to reversal. While amateurs celebrated small wins and moved on, Livermore held his short position with mechanical discipline and rode Steel Common all the way down to 40, multiplying his profits fivefold through patient adherence to objective evidence over emotional impulses. The solution requires installing mechanical protocols that remove human emotion from exit decisions entirely, creating systematic approaches that override your biological programming. You only consider selling when predetermined, objective conditions are met through technical analysis. Never when the fear clock demands immediate action for psychological relief. Your stop loss must live beneath meaningful pivotal points identified through price structure, not beneath the shifting sands of emotional comfort levels that change with every market tick. Exit signals come exclusively from tape confirmation, specific volume characteristics that indicate trend exhaustion, price action behavior at key technical levels showing distribution, and measurable changes in the speed of recovery from normal pullbacks. When healthy trends pull back, they recover quickly on light volume, with minimal time spent below support. When trends are ending, pullbacks become deep and sluggish. Recovery takes many sessions, and volume patterns shift dramatically as smart money distributes to eager buyers. Professional traders develop what Livermore called tape sense through relentless practice and mechanical repetition until objective analysis becomes automatic. They learn to identify when a stock is acting right versus showing signs of distribution through specific criteria. Higher highs and higher lows on expanding volume during advances, contracting volume during declines, quick recovery from pullbacks, and consistent respect for support levels. When these characteristics change measurably, professionals exit mechanically regardless of profit levels or personal feelings about the position. They use position sizing as their primary anxiety reduction tool, typically risking 1 to 2% of equity per trade, ensuring no single position can trigger the fear clock's emergency protocols. The fear clock will always exist within you because evolution embedded it too deeply to eliminate, but professionals train themselves to hear only the price clock's objective signals through systematic daily practice and predetermined decision trees that remove emotion from the equation entirely. Jesse Livermore never bought stocks because he liked their stories, admired their management teams, or believed in compelling fundamental narratives that sounded logical during coffee shop conversations. He waited with mechanical patience for the market itself to confirm his judgment through what he meticulously termed pivotal points, specific price levels, where a stock's behavior provided unmistakable evidence that a significant directional move was beginning with institutional backing. These weren't arbitrary numbers drawn on charts by hopeful analysts or random support and resistance lines that looked meaningful only in hindsight. Pivotal points represented genuine points of least resistance, where the tape revealed objective truth about supply and demand dynamics, demonstrating that one side had definitively gained control over the other through measurable price and volume action. Amateur traders buy on hope, hot tips from friends, gut feelings, or compelling stories that sound convincing in theory. They enter positions based on what they think should happen, rather than what the market is actually demonstrating through concrete behavior. Professionals wait exclusively for objective confirmation from price action itself, understanding that the market's collective opinion matters infinitely more than their personal beliefs. analytical conclusions, or emotional impulses about what seems reasonable. Here's exactly how pivotal points work in real market conditions, demonstrated through a concrete example that reveals the power of patient confirmation over impulsive speculation. Consider a stock that has been consolidating sideways between $45 and $50 for several weeks, creating a clearly defined trading range that most market participants can easily identify on any chart. This sideways action represents something far more significant than boring price movement. Think of it as a coiled spring being compressed tighter and tighter with each passing day. During this consolidation phase, sellers consistently defend the $50 level, preventing any meaningful advance, while buyers aggressively step in near $45, preventing any significant decline. This creates equilibrium. But equilibrium in markets never lasts forever because underlying forces are constantly shifting. The amateur trader sees this sideways consolidation as uninteresting price action that offers no immediate opportunities for quick profits. So they move on to search for more exciting prospects that promise faster gratification. The professional trader sees something entirely different. Potential energy building like that compressed spring, with each test of resistance at $50 creating fewer motivated sellers and each decline toward $45, finding more aggressive institutional buyers, accumulating positions. The pivotal point reveals itself when the stock finally breaks decisively, above $50 on expanding volume that's significantly higher than recent averages, indicating that institutions with massive capital are now actively participating rather than retail traders creating temporary noise. But here's the critical distinction that separates professionals from amateurs. The breakout itself isn't enough. Volume expansion alone isn't sufficient confirmation. The stock must hold above that critical $50 level for at least 3 consecutive trading sessions without falling back into the previous range. Why exactly 3 sessions? Because one session could represent a false breakout designed to trap eager buyers who jump in too quickly. 2 sessions might still indicate a temporary spike that lacks staying power, but 3 consecutive sessions of holding above the breakout level, particularly when accompanied by strong closes and healthy volume patterns, provides compelling evidence that resistance has genuinely transformed into support, and that the market has accepted this new price level as legitimate territory for continued trading. Here's precisely where most traders sabotage their own success through amateur thinking and emotional decision-making. They witness the initial breakout above $50 and immediately purchase their full intended position size, driven by fear of missing the move and excitement about finally seeing clear directional action after weeks of sideways frustration. This approach represents fundamentally flawed thinking because it ignores the mathematical reality that not every breakout succeeds, and position sizing determines whether you survive the inevitable failures while maximizing the successful campaigns that create wealth. Livermore's approach was surgically precise and methodically patient, designed to minimize risk while maximizing profit potential through systematic execution. He would initiate only a small test position at the pivotal point, typically 25% of his total intended position size, treating this initial purchase as reconnaissance rather than full commitment to the trade idea. The systematic protocol for identifying and trading pivotal points requires specific, measurable criteria that completely remove emotional guesswork from decision-making. First, identify potential pivotal points through rigorous technical analysis, focusing on breakouts from well-defined consolidation patterns, decisive moves above key resistance levels that have been tested multiple times, or breakdowns below major support levels that have held for extended periods. These levels must be obvious to most market participants, not obscure lines that only appear meaningful on your personal charts. Second, demand volume confirmation because price moves without institutional participation typically fail quickly and represent false signals rather than genuine trend changes. The breakout must be accompanied by trading volume that's at least 50% higher than the 20-day moving average, proving that serious money is behind the move. Third, require follow-through confirmation by demanding that the stock hold the new price level for at least 3 consecutive sessions without returning to the previous range, giving you objective evidence that the move has institutional support and staying power. Let's apply this with specific numbers to make the concept concrete and actionable. You're watching a stock consolidate between $45 and $50 for 6 weeks. On Tuesday, it breaks above $50 on volume that's 70% above average. closing at $50.30. Wednesday, it holds above $50, closing at $50.15. Thursday, it tests $50 briefly but recovers to close at $50.40. That's your 3-session confirmation. You initiate a test position of 100 shares at $50.50, representing 25% of your planned 400-share total position. Your stop loss sits at $48.80, just below the previous range and the breakout day's low, risking $1.70 per share, or $170 total, keeping your account risk under 1% if you size positions rationally. If the stock continues to act right, making higher highs and higher lows with volume expanding on advances and contracting on pullbacks, you add 70 shares at $52.60 after another confirmation signal. Your stop for the entire position moves up to $50.40, protecting accumulated profits while allowing room for normal volatility. This systematic approach transforms trading from emotional gambling into mechanical wealth extraction, providing the deep conviction necessary to hold positions through temporary pullbacks that would otherwise shake out amateur traders who lack objective confirmation of trend validity. While amateur traders celebrate their first profitable position like lottery winners clutching a modest payout, Jesse Livermore understood through decades of market warfare that real wealth, the kind that transforms ordinary accounts into generational fortunes, never came from clipping small profits and moving on to the next trade. The life-changing money emerged from pyramiding, systematically adding to winning positions as they proved their strength through continued favorable price action and volume confirmation. This wasn't gambling disguised as sophisticated strategy or wishful thinking dressed up in mathematical language. Pyramiding represented pure mathematical precision, applied to objectively confirmed trends, a systematic approach that transformed Livermore's relatively modest $50,000 account into millions during the chaos and opportunity of the 1929 market crash. But here's the counterintuitive truth that confuses most traders and prevents them from ever achieving significant wealth. Proper pyramiding actually reduces your overall risk exposure while simultaneously multiplying your profit potential, creating the holy grail of improved risk-adjusted returns that every professional seeks but few ever master. Think about this with cold logic, stripping away emotional noise and focusing purely on market mechanics and mathematical reality. When you add to a position that's already moving decisively in your favor, consistently making higher highs and holding new support levels with institutional volume behind each advance, you're not buying speculation or hope. You're buying concrete confirmation. You're purchasing mathematical proof that your original analysis was correct and that the market, through its collective wisdom and massive institutional capital flows, is actively validating your thesis with every higher price you pay. The market is literally compensating you for increasing your exposure, demonstrating its endorsement through continued favorable price movement and volume patterns. Compare this systematic approach to the amateur's wealth-destroying habit of averaging down on losing positions. There, you're buying pure hope, throwing good money after bad in a desperate attempt to salvage a flawed thesis that the market is actively rejecting. Pyramiding represents the complete inverse of this self-destructive behavior. You're scaling into demonstrated strength rather than stubborn weakness, aligning your capital with the path of least resistance, which is always the direction of the prevailing trend. Here's Livermore's specific, battle-tested pyramiding protocol that transforms good trades into fortune-building campaigns while maintaining strict risk control. You begin with your initial base position at a carefully identified pivotal point, as we discussed in the previous chapter. Let's work with concrete numbers to make this immediately actionable. You initiate your test position with 500 shares at $50 per share, representing approximately 25% of your intended total position size, with a predetermined stop loss placed at $47. This initial commitment represents your maximum defined risk of $1,500, regardless of how large the position eventually becomes. As the stock proves itself by moving higher and holding above new price levels, demonstrating continued institutional support through expanding volume on advances and contracting volume on pullbacks, you begin adding to your position, but always in diminishing increments that create the classic pyramid structure. Your second addition might be 300 shares at $55, purchased only after the stock consolidates briefly and breaks out from that higher base with volume confirmation. Your third edition could be 200 shares at $62. Following another clear confirmation signal such as a successful retest of previous resistance now acting as support. Each subsequent edition is deliberately smaller than the previous one, ensuring your largest exposure remains at your lowest average cost. The risk management component is absolutely critical and cannot be compromised without destroying the system's mathematical advantages. With each successful edition, you systematically raise your stop loss to protect the entire accumulated position, while allowing room for normal market volatility. After your second edition at $55, your trailing stop for the entire 800-share position moves up to $52, effectively protecting your initial capital and locking in a small profit on your first block of shares. After your third edition at $62, your stop for the complete 1,000-share position moves to $58. This is the mathematical genius of proper pyramiding. You're no longer risking your original capital. You're using the market's money, your accumulated, unrealized profits to fund progressively larger exposure, while your original $1,500 risk remains fixed and protected. The market is literally paying for your increased position size through its continued validation of your trade thesis. Let's examine the mathematical power this approach generates compared to amateur single-position thinking. If the stock reaches $80 and you exit the complete pyramided position, your total profit calculates precisely as follows. 500 shares purchased at $50 and sold at $80 equals $15,000 profit from the first position. 300 shares purchased at $55 and sold at $80 equals $7,500 from the second edition, and 200 shares purchased at $62 and sold at $80 equals $3,600 from the final edition. Your total profit equals $26,100. Compare this to the amateur approach of buying 500 shares at $50 and selling at $53 for a safe $1,500 profit. The pyramided approach generated over 17 times more profit from the exact same initial trade idea and market movement. This isn't theoretical speculation. It's mathematical reality, demonstrating why professionals think in systematic campaigns while amateurs think in isolated trades. However, successful pyramiding demands perfect timing, mechanical discipline, and the refined ability to read when a trend is gaining momentum versus showing signs of exhaustion. You cannot pyramid successfully without understanding market rhythm, volume characteristics, and the subtle signs indicating whether a trend remains healthy and likely to continue or is becoming overextended and vulnerable to reversal. Adding to positions requires the same level of objective confirmation as initial entries, expanding volume on advances, contracting volume on declines, quick recovery from pullbacks, and continued respect for support levels. When these characteristics change, when volume patterns shift or recovery becomes sluggish, the pyramiding process stops immediately and systematic exit planning begins. This is where understanding market rhythm becomes absolutely essential for maximizing the wealth-building potential of confirmed trends. Every sustained trend possesses its own distinct rhythm, and Jesse Livermore became a master conductor of this market symphony through decades of disciplined observation and painful learning. Healthy trends move in predictable, almost hypnotic waves that any trained professional can recognize. Advance on expanding volume, consolidate on contracting volume, advance again with renewed institutional participation. Consolidate briefly as profit takers temporarily overwhelm buyers. This rhythmic pattern creates the foundation for successful pyramiding because each consolidation phase offers opportunities to add positions, while each advance validates your thesis through continued market confirmation. But unhealthy trends approaching their inevitable conclusion display entirely different characteristics that scream warnings to anyone trained to listen. They become erratic and unpredictable. Volume patterns shift dramatically from expansion on advances to expansion on declines. Advances shorten in both time and magnitude, while consolidations stretch longer and deeper, eating away at previous gains. Learning to read this subtle but crucial rhythm meant the absolute difference between riding a trend to its natural profitable conclusion and being caught holding positions during their final devastating collapse. Livermore identified what he precisely termed climax patterns. Specific moments when trends reach complete exhaustion and begin their reversal process, often violently and without warning to amateur participants. In bull markets, these climactic moments typically appear as massive volume spikes, accompanied by dramatic price advances that capture headlines and finally convince the general public to participate, but with little meaningful follow-through the next trading session. This pattern reveals critical market dynamics. When everyone who was going to buy has finally bought, nobody remains to push prices higher. The public's enthusiastic participation at these climactic moments represents the final fuel for the move, but it's also the signal that smart money is now systematically distributing accumulated positions to eager retail buyers who mistake climax for continuation. During his legendary 1929 campaign, Livermore recognized these exact patterns developing throughout September, watching volume explode to unprecedented levels, while price follow-through became increasingly anemic. While amateur traders celebrated apparent accelerating momentum, Livermore understood the market was showing distribution signs and began his systematic exit process, completely avoiding the devastation that crushed traders who held positions too long. Here's his precise three-stage exit protocol that transforms chaotic selling decisions into systematic profit preservation, ensuring maximum gain capture while avoiding the amateur's trap of holding winners too long. Stage 1 activates when you identify climax volume or significant rhythm disruption through trained observation of price and volume patterns. Immediately reduce your total position by exactly 1/3, regardless of current profit levels or emotional attachment to the trade. This initial reduction locks in substantial profits from your pyramided position while keeping you meaningfully exposed if the trend somehow continues beyond the apparent climax signal. You're not abandoning the trade based on single warning signs, but acknowledging that risk-reward dynamics have fundamentally shifted and position size must be adjusted accordingly. Stage 2 triggers if the stock fails to make meaningful new highs within exactly 5 trading sessions after your initial climax signal. This second reduction recognizes that healthy trends don't stall for extended periods without making progress. When momentum stalls, it typically indicates institutional distribution is overwhelming remaining buying interest. Reduce your remaining position by another third at this point. Stage 3 represents complete exit when either your carefully maintained trailing stop is definitively hit or when the stock closes below a major pivotal point that provided structural support for the entire move. Let's apply concrete numbers to make this protocol muscle memory. You pyramided a position starting at $50, adding at $55 and $62, watching the stock advance to $80. A sudden volume blow-off hits at 79 with failed follow-through the next day. Stage 1 triggers. You trim 1/3 of your shares around 78. Price chops sideways for a week without printing new highs. Stage 2 triggers. You trim another third between 76 and 77. 2 days later, a heavy close below 75 violates the last pivotal point. Stage 3. You flatten completely. You preserved the bulk of campaign profits, while others donated gains back to volatility. This systematic exit approach isn't selling because you have enough profit that represents amateur thinking driven by arbitrary targets rather than market evidence. Professional exits are triggered exclusively because underlying market dynamics have fundamentally shifted, and the tape is communicating through objective price and volume action that the trend has concluded, just as clearly as it once communicated trend beginning through pivotal point confirmation. The complete Livermore system integrates every element into comprehensive framework. Identify pivotal points for objective entry signals, pyramid systematically into confirmed strength, read market rhythm constantly for trend, health assessment, and exit systematically when evidence changes. This isn't merely trading individual positions. This represents systematic wealth extraction from market inefficiencies through disciplined patience, mechanical execution, and complete emotional control. Professional trading demands complete process ownership, meaning you follow systematic protocols regardless of short-term results or emotional impulses demanding deviation. You cut losses fast at predetermined stops without debate. You size positions small initially to control maximum risk. You wait patiently for pivotal point confirmation before entry, never buying hope. You pyramid exclusively into proven strength, never into weakness. You trail stops under structural support levels identified through technical analysis, not under arbitrary comfort zones, driven by fear. You let price action and volume patterns, not profit targets or emotional satisfaction, determine exits completely. The fear clock will always scream for immediate gratification, but you now possess the price clock's language. Pivotal points for objective confirmation, pyramiding protocols for maximum profit extraction, rhythm recognition for trend health assessment, and systematic exits based on evidence, not emotion. Master these principles, and you'll never again donate your best trades to your worst impulses.